Hello, Maverick traders. Welcome out to your FX and crypto midweek for July 19th. Corey here with you. Always nice to see all of you. As far as the midweeks are concerned, we're going to change things up a little bit. Instead of calling it a midweek, we're actually going to do an end-of-day video, kind of a recap, and I'll probably be in charge of those still, so it'll have a little bit different formatting, a little bit different approach to it, but I think we'll finish out the midweek here for the next 2 weeks. But just to let you, make you aware of some of the changes that might be taking place here in the near term. As always, a quick reminder to follow your trading plan. So critical to long-term success is that you really follow the plan that you've got set.
Do you want to be a professional trader? Maverick Currencies is the oldest US-based Forex and crypto prop trading company that will pay you for trading with our capital. Trade our capital and keep 70 to 80% of the profits. We are looking for traders just like you that are hardworking and motivated. Click the apply link on the top right of this video. See if you have what it takes. That link takes you to a 4-minute video that explains the trader position available, and you read a list of FAQs that answer pretty much all the basic questions you have at this point. After watching the video and reading the FAQs, if you're interested, fill out an application, then you'll watch the full-length recruiting video, and then schedule an interview with one of our traders. Are you our next trader?
I am somewhat surprised. I wouldn't say I'm shocked by any means, because the market it will do some things that maybe don't make a lot of what you would think is common sense, and you'll find out the why after the fact. So what is the market pricing in here, and why does it continue to chug higher? I feel like I kind of messed up in the market in that I was really bullish. If you go back months, I was bullish through this whole period where it was more difficult, I felt like, to be bullish. And the tendency is that when everyone else starts to get bullish, usually that's more of the top, right? And so the public and so forth. But on occasion, you can work off this exhaustion. So here's where I felt like we had an exhaustion signal. And we really did have an exhaustion signal, but the way I thought it would work is usually you'll kind of have a deeper dive and what we would call a shakeout. A move lower that would really test the buyers. Anyone that was a Johnny-come-lately gets run over and they bail out on their position at a big loss. That's what I was expecting, an ABC correction. And I got the A part right. The B part didn't roll over as I would have anticipated. And instead of correcting down, you just corrected sideways, and then now we've reverted back to the upside. And as we've mentioned, you have to give credit where credit is due. The market is stronger than what we would have anticipated. Last week, we were sitting here in class and we said, well, this certainly could be a false breakout, but we won't know until the following day when either it reverses, and I said if you get a red candle right here, then you'd have trapped bulls and it would get, probably pretty ugly. Well, that didn't happen. The next day, you confirm the upside breakout, and you can see what's transpired in the days since then. So this market just keeps chugging on. Why is it happening? Well, the why is less important than what is happening, and where it's going to go next is of the utmost importance, right? So at this point, if you've missed this last part of the rally as I have, I've not been on board, really bullish, but I haven't been really bearish either, because one of my first principles of investing / trading is do more of what's working and less of what's not. And so in an attempt to, if you had attempted to trade against this market, the very first trade or second trade wouldn't have started to work out, and you'd start to see, okay, I've taken a couple of stabs at it. Clearly, something is going on here that's not what I would have anticipated. Instead of adding more risk, I de-risk, and that's what I've done. So there's been, I would say I'm just doing very little right now. the quantity of trades that I've done the last 2 weeks is much, much lower than almost any other 2-week period for a very long time. And that's because I felt like I was really in sync with the markets for quite some time here, and things were just going perfectly. The markets diverged a little bit here from my viewpoint this last couple of waves here. And so I'm just kind of sitting on my hands and waiting it out. That's from the market perspective. Now, there are some other markets, that's the S&P 500, but of course, there's a variety of different things moving at different times. I had been bearish on gold and silver. We had talked about this back here during this period of time. I'd even tweeted about it, that I really felt like this was a time where gold had reached a point of exhaustion and was likely to correct back down. I removed that bearish thesis down here, not at the perfect lows, but just basically kind of, okay, we're probably not going down much anymore. I had some trades on in the gold markets, gold miners, and so on. That was a beneficial area, but look at where it's at now, and where does it go next is always of utmost importance, right? So now we've rallied for a couple of weeks. Is this a bear rally that's just going to falter off? Is this a rally that is sustainable towards higher prices? And maybe in order to understand the gold markets, we need to back them out a little bit further. And if you really were to go back a long period of time, then you can start to see some things that might be intriguing towards gold. The first, we obviously had a major exhaustion high here, and look at the deterioration. This created a big cup formation, right? This is sort of what I expected the S&P would kind of go through, is an exhaustion top and then a big flush out period and then work its way back up over time. Well, in the gold markets, this took place over the process of multiple months. Notice as we got back up to that level, this is where we essentially said, hey, we don't think it's going up and through. We think it's going to have a big shakeout here, a big bearish move. And that's what's now transpired. And if you look at the math behind this, remember what we always teach with the cup and handle. Take the size of the cup. So 191 is resistance, correct? The support down here is about 151. You see it here. Take the size of the cup, 191 to 151. Well, that's a 40-point cup. The handle should be about 30% of the size of the cup. So if I pull up a calculator and I say, well, the cup was 40 times 0.3, so what's 30% of 40? It's 12 points. So as you back off of 191, you should go down in the neighborhood of about 12 points. Now, again, that's not an exact science, but that's to give you an idea of where the handle should bottom out, the basic size. If the handle deteriorates way down here, you know it's not a cup and handle, of course, right? It should be a shakeout area, but ultimately find some support down in that general area. So we go 191, the resistance, minus the 12. The handle should be down there about 179-ish. And look at where we've bottomed out. A little lower, granted. Maybe instead of a 30, usually the cup is 30% of the size, or pardon me, the handle is 30% of the size of the cup. This one might have been 33%, but it's in that arena, right? In that ballpark. I don't care if it's a 28% sized handle. I don't care if it's a 33. It can't be 45, 50. It can't be 10, right? It's got to be in that general area. And so it bottomed out right there. I mean, you can see where 179 is. It bottomed out at about 176 or something. So right in that general area is where that handle occurred. And so now we're looking at this thing. We're looking at this thing and saying, okay, in terms of outlook and expectation for the gold markets, what's likely to occur? Because you could say gold moves opposite to US dollar, But you can flip that and say US dollar moves opposite to gold. In other words, one is not necessarily leading the other. It's a reflection of the other. It's the very fact that if you want to be out of US dollars, gold is a natural alternative currency. It's basically one of those things where when we look at it and we say, in terms of the expectations of how, essentially how much of my money do I want in alternative currencies, things that are not US dollars in essence, but are currency-like, if that makes sense. So you don't necessarily want your money in stocks or in bonds or whatever. You want a currency-like asset. And gold has basically been that. If you think about the gold market, gold, you could argue, has not appreciated in value since Roman times. Why do I say that? Gold, there's an old saying about gold that one gold coin buys a nice suit. You maybe heard this before. It's a currency. If you go back to Roman times, one gold coin would buy a nice Roman toga, what they wore, right? Fast forward hundreds of years later, thousands of years later, fast forward, and one gold coin still buys a nice suit, right? You could go and buy a nice suit with one gold coin. So it's not an asset that appreciates in value some extreme quantity. It's literally a currency. I mean, that's the value of it. If the price of a nice suit goes up over time, inflation, well, gold tends to track that. But it's not that one gold coin buys 100 nice suits. It's not that one gold coin buys 1/4 of one suit. It's just, it kind of stays around that level. So there's not mass amounts of capital appreciation that way. And you've got to be realistic about what gold is. Gold is a way to retain your purchasing power. It's an alternative currency. So if we think about it that way, our viewpoint on gold often reflects almost an opposite viewpoint on the US dollar, which is the major reserve currency of the world. Gold does best when people lose faith in currency. Gold does best when there's, geopolitical risk, economic uncertainties, all these sorts of things, because if you felt strongly about the economy, you'd want your money in something that's going to appreciate nicely in value, like stocks, right? They're a reflection of business. And so if business is going to boom and AI is going to change the world and profits are going to go up and there's going to be massive amounts of earnings and revenue increases and so on, you want to own stocks. But if you're nervous about the economy, about all these things, you're nervous about your currency losing value, gold is something that you can store some of your money in, and it'll probably retain most of its purchasing power over the long term and stick with, inflation and those sorts of things. So as we look at gold in that vein, well, what's my outlook? You probably already know. I think we've cup and handled. I think there will be pullbacks, and then we're headed right back up towards 191. And as we get to 191, we might base there for a time, and I suspect we'll probably go up and through that level. And so a good rule of thumb is you can basically take the size of this handle right here and flip it on its head and say, well, you should make about a handle-sized move up here, right? And so if this handle is about 14 points or so, you might go 14 or so points above, which would put us at about 205 or something along those levels for GLD. But that's how I would see this market working. A bullish outlook for gold, alternatively, is a bearish outlook for the US dollar. So let's spend some time looking at USD. what do you notice right off the bat? First of all, this is a multi-year chart. Secondly, it does have some characteristics that are kind of interesting in that they look somewhat polar opposite to gold, doesn't it? You had a major inflection point, in this case, a move down, whereas gold moved up. You bounced as gold moved down. This was bouncing. You retested this key level just recently, just a few days ago. And what have you been doing? You've been bouncing, right? So as we look at this over the process of the last few months, you might argue we've been carving out an inverse cup and handle, right? Cup and handle. So let's look at the US dollar along those same lines. If you look at it the way that I do, you'd say support is generally, and remember this is our currency baskets. These are proprietary to Maverick that we've created. It's just building the US dollar against all these other currencies evenly weighted. So this is not the US dollar index, the Dixie, or anything that way. It's just how's the dollar doing overall versus everything else, versus the yen and Swiss franc and euro and so forth. Well, 117, the figure, to, can we call it 124? I mean, it stopped. I get that it stopped just shy of that there, but it was basically there. It makes for simple math, and this is not an exact science. So I'm going to call it as follows. And so if that's the case, well, let's pull back up the calculator, and we say 124 minus 117. What's the size of this inverse cup? It's 0.07. If we were to convert that to currency language and add the other zeros, it's about 700 pips if we were looking at it from a currency perspective. Now, if we were to say, well, what is 30% of that? So we take that number times 0.3, it would be about 210 pips. So this bounce should take us up about 210 above the 117 mark. Let's see if we like that. 119.10. So we're just shy of it. We're at 118.80, and frankly, we might have hit 119.10 on that candle right there. That's entirely possible. If I put my cursor on it and see what the high, look at the high. I promise I didn't know this. Look at the high right up here. If I put my cursor on today's candle, what was the high? 119.10. And it's not supposed to be that exact. It's not going to predict it down to the exact pip or anything like that. That's the area, the general ballpark. So we've basically created an inverse cup and handle, and we're in the handle portion. That's usually where you want to get short. So, I mean, the general thought would be that the US dollar has broken levels of support back here, and that it's bounced up underneath them. That'll act as resistance. This should be the general top of the handle, and that we should go back to this 117 level and then break through there and probably make about, if this was 210 pips, then we'd make about a 210 point pip move below that 117 level. So if you wanted to get really crazy in terms of your target, you'd say 117 minus 210 pips would take us down to 114.90. We're just close to 115. Be like right in there somewhere. That would be a long-term price target. Well, when I say long-term, it's not going to take years or anything, but it could take a few weeks. So it's a little bit bigger picture, a little bit larger overall target. But a move down here in this dollar currency basket towards 114.90. Is the dollar on a longer term trajectory to the downside and so forth? It seems that way, that we're going to continue to have further moves to the downside. That's just the price action itself, the overall trends and momentum. You can see the moving averages rolling over and such. So does a lower dollar help asset prices? Does a lower dollar boost stock markets and economies and so forth? Well, it could be good and bad. It just depends. There's always trade-offs. What's good for one has to, well, doesn't have to be, but is probably bad for another. So if we say a lower US dollar, well, that tends to be good for US stocks. However, a lower US dollar tends to be bad for emerging markets, and some of those, can maybe underperform during those periods of time. Although a massively rising US dollar could be problematic for them on the debt side of things. If we look at a much stronger US dollar, well, then that speaks to people expecting that maybe the rate hikes are not priced in, yada, yada, yada. Right now, why are they selling off the US dollar? Well, maybe they think with inflation coming down, the Fed's on hold and so forth. I don't fall in that category. I think the Fed is higher for longer, and I've talked about this, that I think the markets are ultimately going to be surprised how aggressive the Fed is in continuing to battle inflation, and they have no choice. They screwed it up so bad, and inflation got so rampant, they can't afford to run the risk of massive inflation that just takes hold and doesn't relent. And so they're going to err on the side of being too aggressive in raising rates, and they run the risk of really hurting the economy in the process, but that's the risk they've got to live by. So we'll see how this shakes out, but there are some good and some bad. There are some positives for stocks generally and for assets and so forth, but you can see that trend of the US dollar. Now, well, what we talked about last week was, in my opinion, the two obvious bullish ideas were these two, Swiss franc and euros. So if you're looking at where, at least this is rear view mirror stuff, but if we zoom in here, US dollars on this big trend lower, Swiss franc and euro just look great. Do you chase up here? Well, pick your spots. I'm not saying it's obviously it's not as good as it was last week, but just look at this chart of the Swiss franc. Look at the basing. Look at the little mini pullback here to moving averages underneath and so on, like little mini cup and handles and so forth. And you can see just explosive to the upside. The euro, rock solid. Same idea. 1 week ago, or 2 weeks ago, we were talking about this exact same philosophy in the euro, that this was the area it should find support and so forth, and it has. Now we're back up to the resistance. Usually, generally speaking, you'll break out. You could make a handle-sized move in this direction. So in looking at euro and Swiss franc, I think they've been the more obvious bullish candidates, the more obvious upside ideas. As to what to play to the downside, US dollar, an obvious choice. I've hesitated in shorting the Japanese yen. You could have done fine with it in here. I think that Japan is going to have to relent. Now, they've held out, and even in switching a governor, they're still in that process of easy policy. But I think we're ultimately going to transition, and there's going to be some volatility here that's very unpredictable. So it's one of those things where when you're trading the yen, there's a level of discomfort because I know that there's going to be those 3 and 4% overnight moves. And ultimately, I can't predict them with any sort of accuracy. Even if I know that one of them is speaking. I just don't know which direction and all those sorts of things. So I've been a bit hesitant, and I stick with that hesitancy to short the yen. British pound we talked about last week, just really exhausted to the upside. It's done incredibly well the past few months. I don't think it's anything you want to chase into and rush into right now by any means. And we talked about that last week. CAD, I'm surprised the CAD, we liked it back here. I'm surprised it couldn't hang in better. I wasn't chasing it, but was hopeful that it could base or maybe even, create a little high base pattern or something up here to work with. It's not doing that. And so much so that it broke support and now it's retesting from underneath. So although fundamentally I didn't necessarily want to be short CAD, I'd have to say that the setup is on the short side more than the long side in the near term, it seems. So I don't know. I could see this just being choppy or something along those lines. And then I've not loved Aussie or Kiwi, and they've just done, a lot of choppiness, a lot of back and forth. And those are hard to trade when you're going through periods like this because there's just no rhyme or reason to it. It's just up a little, down a little, all over the place. And those tend to chew you up and spit you out. So I'm not inclined to trade them until they get a little clearer picture. And for me, it's just not there. Good question. Somebody asked about the crypto market. So the only thing I would say about crypto, this was, I won't rehash everything, but we've talked about this was the unknown, right? This was a big news event that came out, stabilization of markets, creating a new exchange, weeding out a lot of the fraudulent actors by creating a major exchange by reputable firms and so forth. This was a very good thing for crypto, and you can see the follow through. Crypto the last few weeks is just basing. It's not deteriorating massively. It's not advancing either. But the US dollar's gone through a big downturn. And the fact that crypto couldn't really participate, we touched on this last week, that it was a little bit of a market tell. As gold was acting well, crypto is just stuck. It's just stuck here. And so I'm not a buyer. I'm not short it either. I'm just essentially watching from the sidelines, and we'll see if we get a really good setup. But I think still I would prefer, if we're talking about one versus the other, I would prefer the gold precious metal market right now. Just seems to be where the action is and where there's a better correlation to US dollar.
Would having more trading capital help you meet your trading goals? Maverick Currencies is the oldest US-based Forex and crypto prop firm. We fund traders just like you with 5- and 6-figure accounts where you keep 70 to 80% of profits. Click the apply link on the top right of this video to start the process. This will take you to a 4-minute video that explains the trader position, and you can read a list of FAQs that answer pretty much all the basic questions you have. After that, if you're interested, fill out an application, and then you'll watch the full-length recruiting video and schedule an interview with our recruiters. Are you our next trader?
All right, Euro USD, sure thing. Let's take a look. So if we look at Euro USD, if I could type it in correctly, some of what we talked about transpiring, right? You've got the breakout. There might be a little pullback coming, which is great, or a consolidation. The next trade is not here in the immediate term. Like, we're not trading it right now based on this one candle down. But within the next couple of days, you could. However, if you go into the shorter time frames, just this little pullback might create the setup you need on a little shorter time period. Like, look at the 4-hour chart. Now this is one where you have been high basing for quite a few candles, and maybe you take a stab at it here for another push to the upside. If we go in a little shorter term, look at the 1 hour. Well, that one's deteriorated a little too much on the hourly chart. But the 4 hour bullish, 12 hours still bullish overall. We know the daily chart is bullish overall. So I'd be somewhat tempted by the 4 hour chart to just play this little pullback for a bounce back up in the near term, something like that. And you might say, even if you don't love this chart, the same principles would probably apply across most of the US dollar charts. So maybe I'd glance at US dollar versus Swiss franc, and it's pretty much the same thing. Of course, it's in reverse because USD is listed first in this pair, but this too would get you short US dollar. So you either buy Euro USD or you short USD Swiss franc. Either one is a short US dollar trade. Similar setup, similar type of dynamic. Maybe the 1 hour chart. No, even on that one it advanced a little too far for my ideal bearish trades. But 4 hour, 12 hour, daily, all still bearish on USD versus the Swiss franc. So probably the right area to be hunting and looking at for possible ideas. All right. Hope this was helpful. We had a request I saw sneak in, dollar yen. So daily chart, more on the bearish side. See that break of the 50 and the little retracement underneath. Nice high volume sell-off, lighter volume on the rally, those sorts of characteristics. Getting a little bounce. 12-hour bearish and setting up as a bear retracement. 4 hour could be a Bollinger Band like setup, maybe up towards the upper band. It would have to fail right here at the 50 MA. 1 hour is probably too high, like we said. But if you're trading one of these little bit longer charts, I like it. I've got nothing wrong. I prefer, like I've said, I'm nervous to be short the yen for those big gaps. I'm not as nervous to be long. I don't see the massive gap to the downside as being as likely as the big gap up in the yen for right now. Because again, I think there's so many people short. It's like this, you just have this dry wood that if there was something to ignite it, it could really go in flames. And that would help you if you were long the yen. It would obviously be very detrimental if you're short the yen. So I think that's where we'll have to keep watching it. Yeah, if it settles above, so if this were to close above the 50 MA right here on the 4 hour chart, then the setup is broken. It just doesn't meet the criteria, even if it comes back below and so on. That's a deal breaker for me. Right now, it's closed on the 50 MA. So if this kind of reverses back down, you'd have that type of dynamic in play. What about Euro Aussie for tonight's news? Well, let's take a look at it together. Having trouble typing today. There we go. Euro Aussie, let's work our way in. So daily chart, still more bullish as we'd expect in the euro. 12 hour, also a more bullish chart. 4 hour, more bullish. 1 hour chart, still bullish. So I think just from a technical perspective, you'd have to be looking at it on the long side for sure. I made an announcement for anyone that jumped in a little bit late to class. We're probably going away from the midweeks and moving them to, I'll still be doing it, but a little different class format. So instead of being in the middle of the day right here, it would be like an end of day video where we recap and we'd still look at things and discuss them and all of those sorts of things. So it'll be a similar format, but we might do more of the end of day type of videos versus the midweeks. We're talking about that on both the currency and the stock and option side at Maverick. So there may be a little transition here within the next couple of weeks, just giving you a heads up, but it'll still be the same information, same trade ideas, that sort of idea. All right, we'll leave it there. Thanks again, everyone, for being here. Have a great rest of your day and a great week ahead. Stay tuned for more opportunities that the market presents you. My leanings are still along those lines of not really trusting the equity rally and not really trusting that stock rally. I'm more trusting that gold can move higher, that the US dollar can continue to move lower, and that the stock market, I think, will succumb to some of the pressures that the Fed is inflicting with higher rates and higher for longer. But these things don't move quickly. And when we're talking about economics and market cycles that way, you're talking about multi-year changes. So they don't change in a flash, but when it happens, it will start to evolve, and then it will feed off of itself. And like we always say, just as buying will beget more buying and more buying, that momentum, when it reverses and things start to sell off, well, then selling can bring about more selling and force liquidations and all those sorts of things. So now is a time to be thinking about that and thinking about where you think markets will be and where you think these things are going in the months and years ahead. Thanks again, everyone. Have a great rest of your week, and we'll see you next time. Goodbye.